Let's be brutally honest. Crypto as a hedge sounds amazing. It sounds like you're holding a shield, walking into a storm, and somehow everything becomes safe. But reality is never automatic. A hedge is not a magic charm. It's a tool, and a tool only works when you use it for the right job, at the right time, under the right conditions. And here is the biggest mistake people make. They want one asset to hedge everything, in every situation, at every moment. Sorry, no. Gold can't do that. Bonds can't do that. And crypto can't do that. The only thing that can do that is a fantasy. So before we talk about when crypto works as a hedge, you need one sentence locked in your mind. A hedge offsets a specific risk. Not every risk. An umbrella is great against rain, but if you bring it into a fight, don't complain when it snaps. Wrong tool, wrong context. Now, what risks can crypto hedge? First, crypto, especially Bitcoin, can act as a long-term hedge against the debasement of fiat currency. This is the key phrase, long-term. Not buy today and expect protection next week. Not buy this month and demand it move opposite stocks next month. If that's your expectation, you're not hedging. You're turning protection into a bet. Think about it simply. Cash gets eroded over time. Inflation is the invisible tax. The longer you sit in cash, the more purchasing power gets eaten away. In that environment, an asset with a credible scarcity narrative, global liquidity, and improving adoption over time can become part of a long-horizon hedge. But there's a condition. You must have time. You must accept volatility. You must be disciplined enough not to panic sell when the market tries to scare you. This is where many people lie to themselves. They say, "I'm a long-term investor," but in their head it means, "I want to get rich fast." They say, "I understand risk," but a 30% drop steals their sleep, a 50% drop triggers panic, and a 70% drop makes them swear they'll never come back. That's not investing, that's emotion. If you want crypto to serve as a long-term hedge against fiat debasement, you need 3 things. 1. Enough time horizon. 2. Capital management so you're not forced to sell. 3. Conviction based on understanding, not conviction based on hype. That's the foundation of crypto investment done like an adult. Second, crypto can hedge a risk that almost nobody discusses honestly: the risk of losing the ability to move your assets. In plain language, when you need to transfer value but the system won't let you, or it becomes slow, expensive, or practically impossible, crypto can create an alternative rail. This is not just about price up or price down. It's about financial freedom at the most basic level. You can hold and move value without asking for permission. But let's be honest again, this hedge only matters if you actually control your assets. If your funds sit on an exchange, you may have exposure to crypto prices, but you don't truly own the hedge qualities you think you own. You've introduced counterparty risk. Withdrawals can be frozen, the platform can break, legal pressure can hit, or the exchange can fail. So if you claim crypto hedges system restrictions, you must understand at least basic self-custody, basic security, and how you would operate when you need to move or convert. Nobody can do that part for you. Third, crypto can hedge certain risks related to settlement infrastructure. Traditional finance has layers: banks, intermediaries, clearing, settlement delays, jurisdiction rules. Crypto runs 24/7. That means, in specific scenarios, crypto can be a backup rail when legacy rails are slow or fragile. But listen carefully. This is not a promise of price stability. This is about the rail, not the price. Now the most important part, when crypto is not a hedge and can actually hurt you more. When markets shift into risk-off, when fear takes over and people want cash and short-term safety, crypto often doesn't stand beside you like a shield. It's frequently treated as a high-risk asset and gets sold alongside equities. When USD liquidity tightens, when real rates rise, when capital drains out of risk assets, crypto can drop hard. So if your idea of a hedge is, "It will save me in every crash," crypto is usually not what you want in a short-term panic. Some people look at the chart and say, "But it rebounds strongly." True, but a strong rebound doesn't mean it hedged you during the fall. It just means it can deliver high returns in the right cycle. That's a different story. Cyclical growth, not instant crisis insurance. So what is the correct framework for crypto as a hedge when it works? If you treat it as a serious crypto investment decision, you need a system, not a slogan. Here's a simple 4-condition checklist. It's easy, but it's sharp. Ask these 4 questions and you'll avoid most self-deception. Question 1. What risk are you hedging? Fiat debasement over years? Restrictions on moving money? Dependence on traditional settlement rails? Or are you trying to reduce losses when markets crash right now? If it's the last one, remember, crypto often fails that test in the moment. Question 2. What is your time horizon? 1 quarter? 1 year? 5 years? 10 years? Crypto can make sense as a long horizon hedge, but short-term volatility is extreme. No time horizon, no hedge. Enough time horizon, and your thesis has room to work. Question 3. What market regime are we in? Is liquidity expanding or contracting? Is policy easing or tightening? Is the crowd greedy or terrified? Crypto is sensitive to liquidity. Ignore that, and you'll always be surprised at the worst time. Question 4. Is your implementation actually correct? Are you oversizing the position and hoping it magically becomes a hedge? That's not hedging, that's gambling. A real hedge requires sizing, a holding plan, and rules for drawdowns. Now let's talk execution. If you want crypto as a hedge component in a portfolio, think big enough to matter, but not big enough to destroy me. This is survival logic. A hedge that makes you lose decision-making ability during volatility is not a hedge. It's psychological weight. A disciplined approach is simple. Use averaging over time instead of all-in emotion. Set rebalancing rules. When crypto grows too large in your portfolio, trim to reduce risk. When it falls deeply, but your thesis remains intact and your conviction is based on real understanding, you follow your plan. You don't need to call the exact top or bottom. You need to be consistent with your process. This is the heart of crypto investment with discipline. And one more critical point. Don't call everything a hedge just to feel safe. Some people say, "I'm hedging with altcoins," while altcoins are often more volatile, more narrative-driven, and higher risk. If you can't distinguish asset quality, you're using a kitchen knife to perform heart surgery. It can cut, but the outcome can be terrible. In crypto investment, maturity is not about using professional-sounding words. It's about knowing what you're doing, why you're doing it, and when you're wrong. A real hedge is risk management, not a story you tell yourself so you can buy without fear. Let's close with a sentence you should remember. Crypto can be a hedge, but only when you give it the right job. It can hedge long-term fiat debasement. It can hedge mobility restrictions and permission risk. It can offer an alternative settlement rail in specific scenarios. But in short-term panics, when the world runs to cash, crypto is usually not your umbrella. It can be the wind. If you want to play the long game, use the 4-question framework. Implement with discipline, size positions intelligently, and understand this. Hedging is not about winning all the time. Hedging is about surviving, so you still have the chance to win when the right regime arrives. That is the essence of crypto investment. Not prediction, not prayer. Process and durability.